All right, let's dive right into this explainer. Today, we're putting the Verizon under the microscope. And I've got to tell you, the numbers are playing some serious tricks on us. For years, right, people have looked at these massive telecom giants as basically just stagnant utilities. You buy them, you hold them, you collect your payout, end of story. But is that really the whole picture in 2026? Today, we're going to unpack the data and figure out if this company is just a slow-moving dinosaur or if there's actually a hidden, highly valuable gem sitting right beneath the surface.
To understand why investors are suddenly paying so much attention, we absolutely have to start right here. 5.7%. That is Verizon's current dividend yield, based on a payout of roughly 71 cents per quarter. Add that up, and you're looking at a massive $2.83 annual payout per share. Now, to put that into perspective, especially for income investors out there, a 5.7% yield absolutely crushes the 2.8% Social Security cost of living adjustment we saw for 2026. I mean, it's a huge number. In today's market, it immediately grabs your attention.
But, a yield that high naturally brings up a pretty big mystery. Is Verizon simply a boring 5.7% dividend stock that you just tuck away in a retirement portfolio and forget about? Or, and this is where things get genuinely wild, is it actually an undervalued AI infrastructure play hiding inside a traditional telecom company? We really need to figure out if this shiny yield is safe, reliable income, or if it's kind of like a dangerous trap masking some underlying business flaws.
Now check out this incredible paradox from their second quarter 2026 financials. Operating revenue actually dropped by 0.7%, down to $34.3 billion. And a major reason for that? People are just holding onto their phones longer. They're delaying those upgrades, which means weaker equipment revenue. So the top line definitely isn't exploding. But somehow, at the exact same time, free cash flow didn't just grow, it surged. It jumped by 24.4% to $6.4 billion. How in the world does a company shrink its revenue but massively grow its free cash flow? Well, it turns out they're hyper-focused on the quality and the profitability of the revenue they do bring in.
If you're an income investor, these specific numbers are the ultimate reassuring evidence you're looking for. Because at the end of the day, dividends aren't paid with accounting earnings, right? They're paid with cold, hard cash. In Q2, Verizon generated $10.4 billion in cash from operations. That's up 16.3% year over year. And like we just saw, that free cash flow hit $6.4 billion. So why does this matter so much? It's because Verizon has that annual dividend obligation of $2.83 per share. Even with all the massive investments they have to make in their network, this leap in cash generation literally proves they can afford those payouts right now. The cash is absolutely moving in the right direction.
But hey, cash flow is just the financial side of things. What about the actual customers? Well, take a look at this number, 184,000. That's how many postpaid phone customers Verizon added in Q2. To understand how huge this is, you got to know that analysts were only expecting them to add about 104,000. I mean, the US wireless market is incredibly saturated. Pretty much everyone who wants a smartphone already has one or two. Finding brand new subscribers when you're already a giant is incredibly difficult, especially with fierce competitors breathing down your neck, and yet they completely smashed expectations.
So how exactly did they pull that off? It really comes down to the new CEO, Dan Schulman, and his simplicity plan. The whole strategy here is to aggressively bundle mobile and broadband to kill churn. In the telecom world, churn, which is just the rate at which customers leave, is basically everything. It is so much cheaper to keep a customer you already have than to go out and acquire a new one. By offering simpler pricing and aggressively bundling wireless plans with their growing 5G and fiber home internet, they're creating customers who are way more valuable and, crucially, much less likely to jump ship.
All right, so the traditional telecom business is showing some serious resilience. But that brings us to the massive 2026 plot twist. The conversation around Verizon is actively shifting from, hey, how many phone subscribers can they get, to this incredibly vital question. How much AI infrastructure can Verizon actually monetize? Artificial intelligence is the undeniable boom of our decade, no question, and running it requires moving absolutely gigantic amounts of data.
When we think about an AI data center, we almost always focus on the first three steps: electricity, massive computing power, and those intense cooling systems. Everyone is obsessed with the power grids and the microchips. But step four is connectivity. You can have all the processing power in the world, but if you can't actually move that massive amount of data between cloud servers, businesses, and consumers, the AI just doesn't work. And extremely high-capacity connectivity requires fiber. Lots and lots of fiber. Guess what? Verizon just so happens to own one of the largest communications networks in the entire country.
And honestly, here is the Trojan horse of this whole setup. Verizon isn't just throwing the word AI into their press releases as some trendy buzzword, they are actively acting on it. They recently announced a massive $1 billion deal with Google to provide dark fiber connectivity specifically to support data center infrastructure. This is proof that Verizon is already monetizing its existing network as crucial AI infrastructure. They're even reportedly looking into converting certain network facilities into actual data center assets. Now, this doesn't make them a pure-play AI company, but it absolutely creates a massive new revenue stream from assets they already have sitting there.
Because of these combined factors, the awesome customer retention and these new infrastructure plays, Verizon actually went ahead and raised its full year 2026 forecasts. They bumped their adjusted earnings per share estimate up to a range of $4.99 to $5.04. But more importantly, they are expecting free cash flow growth of 9 to 10% for the year. This makes the bull case look highly attractive. Because think about it, if your cash flow continues to grow faster than your dividend obligation, well, that 5.7% yield starts to look incredibly secure.
But as focused learners, we always have to look at the whole picture, right? And here's your reality check. $128.7 billion. That is Verizon's net unsecured debt at the end of Q2. Just let that number sink in for a second. To put that into perspective, that is literally higher than the GDP of a lot of countries. It's absolutely enormous, and it's an immediate uh-oh moment for anyone looking to invest here just for the dividend.
Carrying that kind of enormous debt is incredibly risky. Telecom is just a massively capital-intensive business. Verizon has to constantly pour billions and billions of dollars into 5G, fiber, spectrum, and general network upgrades just to stay relevant. Plus, with interest rates remaining high, servicing a $128.7 billion debt load becomes painfully expensive. And all of this is happening while they're fighting off intense, aggressive competition from rivals like T-Mobile and AT&T who want nothing more than to steal their customers away.
Which brings us to a fundamental rule of investing that we can't ignore. A high yield is never a free lunch. Often, it just means investors are demanding a larger return because they're taking on greater risk. Remember, dividend yield works inversely to the stock price. If a company's stock falls because the market is terrified of that mountain of debt, the dividend yield automatically goes up. So seeing a 5.7% yield isn't automatically a sign of safety. It might just be the market's way of compensating you for the very real financial risks that Verizon is facing right now.
So let's weigh the evidence here. On the bull side, you've got that stellar $6.4 billion in surging free cash flow, those expectations-smashing 184,000 subscriber additions, the highly strategic $1 billion Google AI deal, and forecasts pointing to continued 9 to 10% cash flow growth. Sounds great, but look right across the aisle, and the bear case is glaring back at you. Top-line revenue is stagnant, declining 0.7%. The telecom competition is absolutely ruthless. They are dragging around a $128.7 billion debt anchor, and high interest rates are making that debt incredibly punishing.
Which leaves us with the ultimate high-stakes question for 2026. Can one of America's oldest telecom giants successfully transform its massive traditional infrastructure into the next big AI growth engine before that towering mountain of debt catches up to them? Verizon is clearly no longer just a boring dividend story. It's this fascinating balancing act between incredible cash generation and massive financial obligations. You're definitely going to want to keep a close eye on their future free cash flows because that's going to be the ultimate clue to solving this paradox. Thanks so much for diving deep into the data with me today, and as always, keep questioning the numbers.